all around you every single day. Money is in motion. Everywhere you go, there is money moving. You can't see it all the time, but instead of putting it in somebody else's bank or a traditional bank where they're the ones that benefit, we put it into your own bank, which is a specially designed whole life. Why would we do that? We want our money to continue flowing. We want our money to continue moving. That's what the infinite banking concept is. It's continuous flow of your money.
Our initial goal every time is to build a policy as efficiently as we can for the amount of money you want to put into it.
When it's your banking system, every loan payment that you put back in your bank is money that's available the next day. This is the best opportunity in anyone's life right now to get ahead and to become wealthy. What's up, everybody? It's another week, which means it's another wealth webinar. And these webinars, we do them every single week, whether it's raining, whether it's snowing, which we get a lot of that here in Buffalo, whether it's sunny, sleeting, or when the whole country shut down. We still go live for you because that's how important this is. And because we committed to doing this consistently and persistently for each and every single one of you. You know, this morning we did a show. We do it every single week on Wednesdays called What the F Happened. It's a pretty wild show. I got a little heated, not heated, but a little excited, whatever you want to call it. But I was talking about how right now is probably the single greatest opportunity for people to get ahead. Now, I know it doesn't feel that way. You see gas prices, you see what's going on with Israel and Hamas, you see what's going on in Russia, Ukraine, like you see US, like in problems that are happening here, but like, put all that aside. That's noise, right? That's news. Shut the news off and just focus on what you see every single day. Because you see the same thing I do. You see people in positions at jobs. I don't care if it's Starbucks, the grocery store, the gas station, the convenience store, at your own office. We see it in insurance companies. Most people, not saying you, because all of you on here, you're the 5%ers, but most people want to do as little as possible, but they still want to make as much as possible, right? They want to do as little as possible and they want to make as much as possible. So there's an imbalance there, right? You all can see that imbalance. You can't do as little as possible and make as much as possible. It just doesn't work. Like it defies the universal laws. Kind of like gravity. That's a law, right? You jump off of a building and then all of a sudden, just because it's a special day, you're in a special mood, you say, I'm not going to hit the ground. And then I read about in the paper this person that jumped off of a building trying to defy gravity. It doesn't work. You can't beat laws. Well, here's a simple formula for all of you. And I know all of you are successful. You're all doing this, but just tell somebody, share, solve somebody else's problem. And you know, most people out there, I'll tell you, most people, they want to be wealthy. They want to be financially independent. They don't want to worry about the bills. They don't want to worry that groceries are more expensive. They just want to say, screw it, I don't care. I got the money to pay for it. So here's the magic formula. For anybody that wants to become wealthy, this right here, right now, I think this is what, October 18th? This is the greatest time in ever, I think, in history to become wealthy. Do you know why? Because there's a lot of people out there unwilling to do what you're willing to do. There's a lot of people out there unwilling to go the extra mile, the extra step, the extra minute, but you are. So tell people if they want success, all they need to do is go out there and do what everybody else is unwilling to do. Many of you don't know this story, and I'm not going to go long on this because we're here to talk about the infinite banking concepts, and we got a really cool topic, which is why Craig is here and why Stephen are here, but I want to just get this out of the way. I remember when the dot-com crash happened, I was on the verge of not being able to maintain my businesses, Fat Man Board Shop, so skateboard, snowboard shop. And I remember it was getting tough. My business was down because of the recession, and I didn't know what to do. So I put a resume out to get a job, and I got I got phone calls and emails from Wall Street firms. I ended up going on interviews. I ended up taking a job in Wall Street because I just didn't know what else to do. I was backed against the corner. I had to get a job, and the only people that would hire me was Wall Street. So I started there. Very early on, I noticed some things. And folks, I know all of you notice these things too, but I want you to become really keen because sometimes we go through life and we just don't see the opportunities right in front of our face. The signs are there. So when I was in Wall Street, I was sitting in the cubicles in the middle, as they call it, the bullpen. We're pond scum, right? When you start in Wall Street, you're pond scum. That's just what you are. You accept that. But you look around and you see these big glass offices all around the office. And in those big glass offices, are the financial advisors that are making the big bucks. That's what I saw. I watched them because I wanted to be them. I wanted one of those offices. I wanted the assistant. I wanted the paycheck, because the one thing in Wall Street that they're very good about doing is posting everybody's numbers. Back then it was posted on a board in the office. Today it's just on a computer screen in an email. But back then there was a wall, and that wall had all the production of all the reps. Like, so all the financial advisors, their production was put on there, and you always looked at the top, 1.2 million, 3 million, 500,000. And then there was me down here, 40,000 or 20,000 or whatever it was. I, of course, wanted to be that person up there. So if you want to be that person, what you do is you watch what that person does, right? You mimic them. They always say your net worth can be a reflection of your net work. So I was just watching them. I was just looking at what they were doing. And you know what I saw was not what I thought. They would come in right around the opening of the bell, 8:45, 9 o'clock at the best. They'd leave for 2-hour lunches almost every day. Like every day they were gone. And I was like, oh, they must be going out and seeing clients. They must be taking a client out to lunch. And some might have been, most were not. And then 4:30 happened, ghost town, crickets everywhere. The girls up front, oh my God, don't bring them any paperwork at 4:30. No, 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 no. We close at 5, Chris. So 4:30, we don't want anything. And if I brought it to them, I'd have to kind of beg them. Hey, I'll bring you donuts tomorrow. Can you please process this? I want to get this in. Everybody did only what was expected of them to get where they were. So what did I do? I started showing up at 7:30 in the morning, got all my paperwork done. I started working through lunch, pounding the phone on lunch. When everybody left at 4:30, what did I do? I stayed. I set appointments, because you know when people get out of work? 4 to 5 o'clock. So that was the best time for me to call people and get them on the phone. And then I'd go out and see them. And I'd work till 7, 8 o'clock, sometimes 9 o'clock at night. I'd drive 2 hours to see a client. I'm not trying to brag or give you guys anything that you shouldn't already know, but what did I do to become number 3 in that office? Now, some of you are like, oh, you weren't number 1. Why? Well, because my partner in the end was that guy at the very top. And my other partner was the guy underneath him. And they got paid off of all my production, okay? Because that's how it worked. I came in under them. They got paid off of it. So literally, I couldn't be number 1. It was almost impossible. But the beauty was I got to be number 3 because I did what all of the others were unwilling to do. So if you want to have massive success right now, it's like the easiest time in history, like literally, like throw a dart. Like, remember, if it was a bull market, you just throw a dart at a wall of stocks, whatever you hit, it's going to make money. Well, right now, you just throw a dart. When the company or the business you work for closes at 5, you stay till 5:30. When the business or company you work for opens at 8 and you're expected to be there at 8, show up at 7:30. Show up at 7. Show up before the boss gets there. So when the boss comes in, it's like, why are the lights on? And, oh, sorry, boss, I'm here catching up. It's 7 o'clock. We don't open till 8. Yeah, I know. I just wanted to get a jump on it. I had a lot of stuff and a lot of exciting things I'm working on. I just wanted to get ahead of it. And then the boss is like, huh. And then the boss, if they're smart, will be like, that'll be the last time I ever get beat here. The boss will come earlier the next day. So you come even earlier. You know who else did this? Brady. Brady was always the first one in the gym. Always. And if one of the rookies or one of the other players came in earlier, he came earlier the next day until nobody would get up as early as him. He outworked them, folks. That's all he did. He did what they were unwilling to do and broke them because they weren't willing to go that extra mile. There's a book called 3 Feet from Gold. Greg Reed wrote it. You know why so many people don't reach their goals, don't reach their dreams, don't have the wealth they want? Because they stop 3 feet from gold. Read the book. It's a great book. You'll learn a lot from it. So why did I open with that? Well, I opened with that because that's the secret sauce. Earl Nightingale in The Strangest Secret in the World says it eloquently. He talks about this whole study they did, and I'm not going to go into it, but he talks about the difference between success and failure. What was it? Creation. What do the successful folks do that the unsuccessful folks don't? Or what do the people that succeed, at retirement, according to Social Security, do that the people that are considered not able to retire or not financially secure? What is the difference? Creation. Create it, folks. Like, I'm not standing here because I got lucky. I'm not making the money I am because I got lucky. I assure you, that isn't it. I just outwork everybody. As Pace Morby would say, I fell in love with digging. So many people, they want to dig a ditch, and they dig and they dig and they hate the digging. And then when the ditch is done, they're done. They put the shovel away. Oh, the ditch is done. me, Pace, and a lot of other successful people, the only difference between us, if we're all ditch diggers, right? What's the difference between us and the ones that didn't make it to where we are? We just fell in love with the digging. Everybody else fell in love with finishing the project of the ditch. And when the ditch was done, they were done. They're like, oh, I'm done. Yeah, half a day. I guess I get to go home early. We just fell in love with digging, folks. That's the hard work. Unfortunately, creation, success, it ain't easy. It's not. So what I thought we would do today, and there was a question that came in earlier, and I do want to talk about the infinite banking concept because a lot of people are confusing just little things. So I'm going to hit some of these little things as we go. Me and Craig are going to do this, and Steven's going to help, and chime in and help with answering some of your questions. But let's just set some ground rules real quick. First thing, any of you that have a question as we go through this, we will be watching the chat, but more specifically, we will be answering questions in the Q&A. So if you have a question, please put it in the Q&A. It will help us greatly because we got 111 people. We'll probably have 150. It's hard to keep up with 150 people's chat. So put them in the Q&A. Second thing I have, little housekeeping. All of you are on here. Did anyone pay to be on here? No, none of you paid, right? It's free. You just click register. You put your name, your email, just so we could notify you and let you know when the thing started. And we even gave you books as a reward, right? So you didn't pay to be here. But we're here giving you an hour and a half. There's 3 of us giving you an hour and a half of our time. What is that worth? Well, if you believe your time is priceless, it's worth a lot. But also your time is priceless as well. So that's an even exchange. But I have one ask. That's it. I have an ask for all of you sometime today, okay? Not tomorrow, not the next day, today, before you are done and you go home. I have something you have to do. Fair enough? How many of you are willing to do that one thing I'm going to ask you to do? Put I in the chat right now. Just one thing. It'll take you 30 seconds. I'm holding you accountable. You are raising your hand. You are committing yourself. You are saying, I am willing to do that. I am willing to create with you. Here's what I ask. You go to my YouTube channel at the Chris Naugle. It's just my name and put the in front of it. Pretty simple. And you click the subscribe button. That's it. You're done. Done. One, if you're an overachiever and you want to go and do what everybody else is unwilling to do or won't do, is just click that little bell too. So you're notified when we do Ask Me Anything today at 4:30. And when we do WTF, you'll be notified if you click the bell. That's it. So technically 2 clicks. Subscribe, click the bell, smash the bell, as I always say. That's my ask. So there's an interesting thing that we're going to talk about today. And this is almost giving you a glimpse of the future. We've been doing this a little bit. Craig's a genius when it comes to spreadsheets and formulas and just figuring complicated things out, but explaining it really simply. So this example today is a real example. It's a real client. We can't tell you who the client is, but he's a business owner. And the business owner had what I would say is a pretty normal request for many of our clients. For many of you, you ask us this all the time. He wants to know what is the most optimal funding for his policy. And is there a way he can dump a bunch of money into the policy and then put the least amount in each year, but have the ability to continue funding at higher levels if he wants, right? So he kind of, in our opinion, he wants the cake and he wants to eat it too. Is that the right way to say it, Craig?
I think it's a great way to put it. He's really just business rhythms change, right? So sometimes we hit that vein of gold and we're chipping away at it, and sometimes we got to dig. So just like in his business, he's got revenue that comes in bulk, and he wants to be able to handle that when it does come in. So absolutely.
So we're going to get into that in just a second, Craig, but I want to go back. All of you, when you ask us a question, I don't care if it's on our Facebook group, which is the Infinite Banking group, okay? It's the one that's got kind of the little QR code on it. Okay, that's our Infinite Banking group. You're welcome to join that and become and ask any question you want. Some people ask us questions on Ask Me Anything. Some people just email us. Happens all the time, or text or DM us on Instagram or any of the other sites. So we always try to answer them. So I want to be very open, and I want to answer the question that came in early because it's a really good question. And if he or she, because it was said anonymous, if they had this question, I'm sure somebody else does. So before we start, Craig, if it's okay with you, I'm gonna knock this one out of the park real quick because it's super easy. Cool?
Sure, go ahead.
All right. So folks, here's the deal. You're gonna learn the infinite banking concept in one capacity or the other, but it's pretty simple. We always explain the infinite banking concept in the form of a circle. Why? Well, because a circle is end to end. Okay? It never has a break. It just continuously flows around the circle. And that's kind of what we want our money to do. We want our money to continue flowing. We want our money to continue moving. That's what the infinite banking concept is. It's continuous flow of your money. Because I mean, think of water, right? Rain comes down, hits the ground, gets absorbed into the ground, finds its way underground into a brook, a stream, or a river, takes that river to a lake or an ocean, eventually it lands up in the ocean, sun hits the water, evaporates the water, goes back into the clouds, rinses and repeats the cycle. It just continuously does that over and over. So your money should just do the same thing, continuously flow around the circle, the cycle. Okay, that's what we want our money to do. Now, here's the funny thing, though. As we all know how water moves and water flows, same thing with money. All around you every single day, money is in motion. Everywhere you go, there is money moving. You can't see it all the time, but it's moving. People are Venmoing, people are depositing money in the bank's lending money out, people are making payments on those loans, then those loans are being, those payments are being lent back out. It's all around us. So if money's always in motion and it's all around us, then it makes it a lot like water. So if you want to make more money, what would be the easiest thing to do? Wouldn't it just be to somehow find a way to disrupt the flow of that money? Think of a river, right? If we had a raging river, and I'm sorry, my drawing's going to be a little rough, but here's the raging river, okay? And then here's you sitting on the outside of the river. Are you ever going to disrupt the river standing on the bank because you don't want to get wet? Because this river is really cold. Let's just say this river is 32 degrees. Standing on the edge, staring at the water. Can you disrupt the water standing on the edge? No, it'd be tough, right? If you had no tools, no sticks or nothing, you couldn't disrupt the water. So if you wanted to disrupt the water, you'd have to get in the water, right? So you just get in the water. Here's you now. You're freezing your ass off, but you're disrupting the water. And then you put a hand in the water and you further disrupt it. And then you basically find a way to like take your body and you disrupt it. You're disrupting the water. Money is the same way. You want to make more money, get in the water, get wet. It's not going to be comfortable. It's going to be hard. It's going to suck. You're going to have to learn new things. In this case, the person's freezing their ass off, but they're disrupting the water. But would you be okay freezing your ass off if disrupting the water meant that it was an extra $1,000 a month in your wallet? $2,000 a month? $3,000? All I'm going to show you here is how to do the exact same thing with money by disrupting the flow. And the disruption happens over on this side, okay? Because this is what we're going to call an opportunity. Now for today, I'm going to use a private lending deal. Some of you we could do debts to. We can actually do both. But I just want to get this out of the way as quick as I can. If all we got to do is disrupt the flow of money, wouldn't it make more sense to have our money start in a place that pays us interest and dividends? It would, right? But you are all thinking, yeah, but my bank account pays me interest. Chris, I'm getting 5.5% on my bank account. Good for you. Let me have you do an exercise. What I want you to do is I want you to go to your bank account that has 10 grand in it, and I want you to take the 10 grand out. Just take it out. Take the 10 grand out and put it into a real estate deal. Okay? All we're doing is we're taking 10 grand from the bank account and we're moving it over here. Now let me ask you a question. Does the bank still pay you interest on the 10 grand? Of course not, right? You took the money out of the bank. The bank's not going to pay you on money that you took out. That's silly, right? Chris, that's stupid. Why would you even ask me that? Well, because everything we talk about with the infinite banking concept is this continuous flow of money, but it involves changing one thing, and that is where your money goes first. Instead of putting it in somebody else's bank or a traditional bank where they're the ones that benefit, we put it into your own bank, which is a specially designed whole life. Why would we do that? There's a lot of reasons, but let me just give you one main reason. Just imagine this. Let's say you had 10 grand that you put into your specially designed, and I always got to preface that specially designed because this is not the whole life that your broke ass brother-in-law sells you. This is specially designed to do what I'm about to tell you. You got 10 grand in there, and just for the sake of keeping math simple, let's just say we took 10 grand out, but we took it out as a loan. So the insurance company gave us a loan from their general account. How much money is left in your account? You started with 10. The insurance company gave you a loan for 10. If it's a loan, you can kind of piece it together. There very well may still be 10,000 in your account earning interest and dividends. Already that's better than the bank because now you got 10 grand earning compounding interest uninterrupted. But then I said a swear word, that loan, right? I said that loan. The insurance company's going to loan money to me. I don't like that. I don't like loans. Loans are bad. The insurance company makes a promise that they're going to give you a death benefit when you die. But the insurance company never says you can't use this death benefit when you live. So that 10 grand we took off, that was a loan against your death benefit. So if you started with a $100,000 death benefit, you take 10, you got a $90,000 death benefit left if you died. Fair enough. The insurance company just gave you part of your death benefit early from the general account that they would pay your death benefit from. And they charged you interest on that. Now, I'm not even going to use numbers, but let me just do some math. If the insurance company paid you an interest rate that was higher than the amount they charged you on the loan, would you consider that a win? If your money was earning a higher rate of interest and dividends than what they charged you, would you consider that a win? Well, I sure hope so, because banks consider it a win. It's called a spread. So that's why we use a specially designed whole life. But the money that goes into the whole life, to that person's question, these are premiums. We call them premium deposits. Where do premiums come from? Well, of course, they come from your income. So you make money. From that money, you pay your expenses, but you also save money. So this is the worst part. We can't help everybody with the infinite banking concept, which is why we've uniquely aligned ourselves with people like Christy Van from Fantastic, who can help people that are living paycheck to paycheck, who don't have any money to save. She helps them create a savings by doing that through Velocity. But when you can save, that's called your premiums. Now, I want you to remember that this is number one. Premiums are your first step. Those are your savings. Savings and premium are the same thing. Now, we take that 10 grand and we put it over here into a real estate deal. Let's say that real estate deal pays you 12%. Or in this case, we pay off a credit card that was 12%. Same difference, right? So we buy a piece of real estate, lend on a piece of real estate, or we pay a credit card off. Doesn't matter. That 12% that you used to give to the credit card, that used to leave your family every month. And the money that you're going to make on this loan that you did on this real estate deal didn't exist before we did it. But what would most people do? If you lent $10,000 out and you got paid 12% and that check showed up in the mail, let's just pretend this is your check, okay? This is your check. You get it in the mail. What do you do with it? What do most people do with it? They take the check and they deposit it in their bank, right? Okay. But why would we deposit it in their bank when we have our own bank? See what I'm saying? So instead of taking the 12% interest and putting it in somebody else's bank, or taking the payment that you used to make to the credit card that we've paid off and giving it, to somebody else's bank, all we do is we set up a loan repayment. Now, I know this is hard because a lot of people don't like to repay loans, especially when the loan originated from money that you'd already saved, but stay with me. This 12% interest, or this 12% you used to give away to the credit card, it's got to go somewhere. It's just like that river. Water always has to go somewhere. And the last place that ends up is in the ocean, right? It's got to go somewhere. You have the choice of where your money goes. The rain doesn't have a choice. It ends up in a lake or an ocean, period. You have the choice. So all we're doing is this loan repayment is repaying the $10,000 that you took out, and it's just putting the money back in your account. But when you think of a loan repayment in the general context of everything you've been taught in your life, the loan repayment you don't get to keep. But that's because you're not thinking about this right. You're still in the mindset of somebody else's bank. When you own the bank, when it's your banking system, every loan payment that you put back in your bank is money that's available the next day. Because, I mean, hey, let's face it, like if you put this 12% interest in Bank of America, that's interest, that's money that the bank can lend out tomorrow. Not you, the Bank of America can lend it out. Not you, the Bank of America can lend it out. Everybody getting what I'm picking up what I'm putting down? I'm repeating myself. So if that's how Bank of America works, if you were the bank and you made the loan repayment back to your bank, who gets to use that money? You do. But you see, this loan repayment is different than the premium deposit going into the policy. These are completely independent of one another. The premium deposit is nothing different than the money you save today. You save it in a 401k, you save it in a brokerage account, you save it in a bank account. Same exact thing. The money you earn from lending money on a real estate deal or buying real estate, or the money that you could take back from paying off a credit card, that's money that was just literally, I don't want to say it was created out of thin air, but really it was money that never made it back into your bank. It made it into somebody else's bank, always. Now it gets to go back into yours. This is number two. Premiums are the savings. Loan repayments are new money created from your initial 10,000 going to work for you. How it goes to work doesn't matter. That's however you want to disrupt the flow of money. We call it an opportunity. This is just your disruption. I've never done that before, but it just came to me as I got that question. Hopefully that helped. I probably spent way too much time on it. So Craig, sorry, man, it's all you.
No, I mean, I think we want to see if anyone has questions on that and we can address those, and then we can kind of jump into some of the pieces that you and I have been talking about. So any questions, go ahead and put them in the Q&A. It's the best place to find your questions, but I know there's been a lot of things scrolling in the chat window as well.
Well, let's dive into
All right.
this example, Craig. Let's talk a little bit about how we would go about designing it for this particular client who wants kind of his cake and wants to eat it too. He wants the ability to put a bunch of money in, but then have the requirement to put as little as possible in premium deposits in the future. But then he wants the ability to put the most amount in still. Like, it almost seems like he's asking for the impossible.
Yeah, and I think where it stems from, and anyone that runs a business knows that there's ebbs and flows, and so he knows that he's going to have chunks of money, and he wants to be able to park it somewhere, just like what you're talking about in the circle. Wants to be able to park that money in his own system so that he can pull it back out for his business and use it. What we end up doing is designing a policy and then showing him the range, if you will, of, hey, if times are skinny, this is what you can put into the system. And when times are full and you're making lots of money and you need a place to put it, here's how much you can put in. So all of these things we talk about come down to understanding, what are you trying to accomplish? What are you trying to do? And then we can kind of back into the policy design. But now when we build in this level of flexibility, what happens? Well, we have some inefficiencies if you don't use it. So let's say that, Chris, you're going to fly down to, say you're flying down to Cancun, and you think you're going to take Vivi and Larissa with you. But maybe your neighbors want to come along too. So you end up buying 5 or 6 extra seats. Now, it's great if you can use them, but if you don't use those seats, what happens? Didn't you just waste that money? Isn't that money just kind of wasted? So that's one of the things that we're talking about too with these policies, is we can build in, we can buy some extra seats, but if you don't think you're ever going to use them, then there's no sense in buying them to start with. So Chris has got an airplane up there. I love it.
I just like visuals, man.
So, I mean, typically you would need, 3 seats, but if you want to take a few neighbors and maybe even bring, Steven and myself along, yeah, maybe you'll buy some extra seats in case we can make it. So that's just the analogy that I'm bringing to the table is, hey, it'd be great if everyone shows up. Now with this business owner, he does think he's going to be able to make this stretch on the maximum side, but just wants to prepare, hey, if I can't make it, what am I on the hook for? And so that's all we're talking about with this policy design.
A lot of people, when they wake up in the morning, they get a glass of water or a glass of coffee, right? So a lot of people have these automatic coffee makers. I know I have one of those Nespressos. Nespressos don't make a lot of coffee. So if I pulled out my big old man mug like I used to when I made a big pot of coffee, I would fill that cup all the way up every single time, right? So I had a bigger cup. But now Nespresso only puts a little bit of coffee because it's a lot stronger. So I don't need as big of a cup. So I can go with the little cup that is a less volume, that doesn't weigh as much and probably doesn't cost as much, because I just don't need that extra capacity to hold that extra coffee. I mean, same idea as the seats. Like, I might just need just a little bit of, one of those little espresso cups, because that's all the coffee that I need to do the job.
Exactly. So, I mean, that's essentially what we're talking about today, is just a business owner wants the flexibility. Now, you as a person, you might want some flexibility in your plan as well, but just know that our initial goal every time is to build a policy as efficiently as we can for the amount of money you want to put into it. But there are ways to kind of make the bucket bigger if need be.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
I guess with that, Chris, do you want me to kind of share out the policy designs and kind of jump into that?
Yeah, I think a lot of times people like numbers and some people like conceptual. So we did conceptual early. So let's get into some of the numbers.
Do you see the wall of numbers?
How many of you love walls of numbers? Just to get a roll call here. We got 126 of you. How many of you love numbers? One. Awesome. Oh, no.
Just one. All right. Well,
not bad. So we'll talk to like 0.5% of the audience here, but that's okay. We'll bring it full circle.
Oh, wait a minute. We have some more coming in. Love the numbers, love the numbers. So there's different types of ways to tell stories, right? So Chris, you're drawing a plane, you're very visual, you've got your board, and I think my special skill in the world is I tell stories through numbers. And so everyone's kind of got a way to tell their stories. But where we started and what you're looking at here is called a cash value analysis. Where does this come from? It comes from the illustration. And a lot of you that have done infinite banking, you have an illustration. You've been provided an illustration. And what that's showing is you year by year, what are you putting into the policy? What are the guaranteed numbers associated with your contract? And then there's non-guaranteed. What you're looking at here is a specific design going year by year. And how much are we putting into the policy? And then in your contract, there's going to be a guaranteed interest rate. Now, when you opened up your savings account at the bank, did you get a guarantee that they're always going to give you that high yield savings account? Are they always going to give you that 4.5, almost 5% on some of those high yield accounts?
Gosh, I don't know. What's everybody getting on their savings account? Anyone getting over 5.5% right now?
And if you are, did you get a document that it's a contract that's set in stone? Probably not. But anyway, with these contracts, you do have a guarantee, so we can always rely on that at a minimum, right? Oh, you know what else? Let me just tell you, Halloween's coming up, and the banks are always handing out the dum-dums. So Tess, you remind me of the dum-dums. I was thinking everybody that opens their own infinite banking policy, you know what kind of candy you should be eating? Smarties. Everybody should get a package of Smarties for their own bank. I love paydays too. Yeah, those are one of my favorites. But anyway, so after you get your first policy, go buy some Smarties and hand them out. All right, so back on track. So we've got our guarantees, which you won't get with a savings account. And then everything in this blue section, these are what we call the non-guaranteed, or where the dividends coming into the play. So what we're typically doing when we start thinking about how much money can I take out for a loan, we're going to be looking at these projected cash value numbers, taking 90% of that. That's really what's going to drive what's available in terms of the cash value. So now here's where we are with this particular person. They have a business, as we mentioned. They said, hey, I want to be able to put in somewhere between 50 and 100,000 a year. But as Chris mentioned earlier, a lot of times people are saying, but I don't want to have a large ongoing premium commitment. So I want to try to squish that down as much as we can. Now, what you're seeing here is there's a $100,000 dump. So the way we structured this policy is a $100,000 dump, a $23,000 ongoing annual premium, and it's on what we call a 75-25 split. Lots of numbers here. So what we're talking about, let's back up. What is a dump? Let's say that you go down to your bank and you open up a savings account. They always ask, well, how would you like to initially fund this? So you might drop in $1,000 from your checking account or whatever it might be. This is the same thing we can do with a policy. You can just drop money into it. So it's kind of a one-time funding. That's typically how it's done. But in this presentation, you'll see that there's more to it. The dump-in has to be supported by an ongoing premium. And that's why we have this 23 here. Our friends at the IRS, what was it, back in the mid 80s, early 80s, they came in and they created this modified endowment contract rule, where what they said is we're no longer going to allow people to shove hordes of money into these policies without some sort of constraints. So that's where this whole modified endowment contract concept came from the IRS. we now have to have a certain amount of death benefit along with the amount of money that you're putting in the policy every year. So that's why in our designs, we always have to have a certain amount of ongoing premium. That's the 23,000. Now,
Hey,
the question is,
Craig, real quick on the mech.
Yeah.
One thing I do want to kind of call out, and this is maybe something people don't know, is the mech rule was put in place in 1988, and that was because wealthy individuals were shoving massive amounts. Oil tycoons mostly were putting billions of dollars into single premium whole life policies, and that money could just live in that whole life without any taxation for the rest of their life. Even the growth was not taxed. So they got wind of that, and they put the kibosh to that with the mech rules. And then the only other change ever to whole life insurance policies happened, was it 2 years ago now? The 7702 change, where they reduced the guaranteed interest rate on the policies because of the low interest rate environment. So I just want to preface it, since the tax code's been around 1913, there's only been 2 changes to the tax code and how the tax treatment of whole life insurance is, or the tax treatment of life insurance. Now, not to hit below the belt, but let me pivot to IULs. IULs, I think they haven't even been around that long, but there's been, I can't think of how many regs have come out, not tax law regs, but just regulations to change how the illustrations are, change how they're being sold. There's been so many regs that have come out on IULs to limit the agents and the advisors from how they illustrate the hypothetical numbers on IULs. I just want to preface, like, the reason we don't talk about IULs is because there's so many faults that you're not hearing about. And if you look up the regs and all the changes that have been put in place over and over and over again on IULs, you'll start to see there's some holes there. There's some problems there. Whole life, that isn't the case. That's why we use it, amongst many other reasons. Sorry.
Yeah, no, I think it's a very relevant point. I'm glad you brought it up. So, but that's really what's driving when we're designing. We have to keep all of that in mind. So the point I want to make is, can I go lower than 23,000 because this business owner wanted to go lower than, the lowest amount he can? And on this particular type of design, the answer is no. I took it as low as I could in terms of the ongoing premium. So what does this 75-25 mean? Throw in the chat if you know what that means. I just want to kind of see who's got some ideas of what does this 75-25 mean? What am I doing with that? And if you don't know, that's great. I'll go over it anyway. 75%. Yep. So Glenn nailed it. So what we're doing with this is that 23,000 that's going in every year, we're breaking that into 2 pieces. 75% of it's going into a special rider called the paid up additions. That's what creates all this cash value over here. So when we look at this 114, this is coming from the paid up additions, the dump ins. Now the 25% is the base. And so that is what is required every year, is that base. And when I get to the minimum illustration, you'll see what I'm talking about. So in our designs, we're taking the full amount of premium, breaking it into 2 different chunks. In this case, it was a 75-25. You've probably heard of 60-40s. You've heard of 70-30. So we have different designs we can apply to these policies. So in this case, what I wanted to show him was year 1, you're going to dump in 100,000, follow up with $23,000 annually. So first year is 123. And then you see year after year, it's 23. And then all of a sudden it drops down to 21,656. And it kind of stays there for several years. And I think that drops down at 0. But what I was just showing him is this is based on the current MEC rules. And I want to make sure everyone understands that those MEC rules can change every year. And they do change based on dividends and growth of the policy. But as illustrated, he should be able to put in this much just kind of ongoing. So this would be his ideal plan. If all things go well, this is what he wants to do. So now the next thing is, what if times are slim and he only wants to do the bare minimum? What does life look like in his policy? So here's what I've done. It's the exact same design. So guess what? Nothing changed. It's the same design, the same $100,000 dump in, $20,000 or $23,000 premium on that 75-25. But what we want to present to him is Year one, he's already planning on doing this 123, so that's not a problem. But what if year two, business declined, maybe he just didn't have the money? So what is the bare minimum that he can put into this policy? Well, there's three ingredients that he needs to think about. The first is the base. The base of the policy, we always want to think of that as this is what's required. This is what you need to put in, especially in the early years. You need to put that much in to keep the policy healthy and happy. That is the base of the policy. All right. So when we take that 23,000, put it in the 25%, this is going to be the base portion. Now, guess what? When we wanted to put in that $100,000 dump, so Chris, if you look at that plane on your board, this is where we're buying some seats. The term rider buys room for you to bring you onto the plane. The term rider allows you to put more money into the policy above and beyond that 23,000. So think of the term riders, we're just buying seats on the plane. Because I bought those seats, guess what? It cost me $1,344 every year for the first 7 years. So we're going to keep that on for 7 years. Because we added that in as room, we need to continue to pay that, because if we don't, the policy could mech out. So guess what? We've locked ourselves in to the base plus the term. And then there's this little $120. Does anybody know what that little $120 is a year? Chris does. I bet you Steven knows. How about anybody in our audience? Do you know what this $120 is? Term, processing fees, still searching. PUA,
Yeah, well,
close.
Celeste
is
really
close.
We've never
Did
really
you
talked
know?
about
Yep.
this, Craig. We've
Peter.
never really hit this.
Peter's a winner.
Yep.
Peter's well, it's a rider fee, right? So when we're adding paid up additions, yep, Peter's got it. So when we're adding paid up additions into the policy, if you're not adding anything at a bare minimum, you want to make sure that you're paying the rider fee. If you don't, what happens, Chris? What happens if you don't pay that for the year?
Well, the insurance companies love to take the option to put money into the paid up additions way after 2 years. They love it. They don't want you putting money in their general account, getting paid interest and dividends on all that money. So if you if you just do the bare minimum and you miss that 120, they're going to take it away after 2 years. Happens all the time.
Yeah. So you always want to make sure that happens. So if we take that 5750 plus the 1344 term rider plus this 120 to keep that ability to add paid up additions, even though we may not be doing it this year, we want to keep that option open. So how cool is it that the minimum requirement for this policy is 7,214? So in year one, you put in 123,000. In year two, you can get away with 7,215. How cool is that? If you're a business owner, does this give you some pretty good comfort knowing that if times are rough, you can always, back it down? I mean, I think that's going to give you a lot of flexibility. Now, what's the downside to this? Look at year two's projected cash value, 123,788. Let's just go back real quick to the policy where we were putting in 23. Well, it's 139. Of course, if you're not putting in the 23,000 or above that, the cash value is not going to grow as fast, right? So instead of the 139, now we are at 123. So we're going to slow the growth down a little bit doing this, but guess what? We're still going to have our banking system intact, and we put in that 7,215 as the minimum. So that's the minimum side. Now, who wants to see the maximum side? So I see Peter saying, can you increase after that? So everybody wants to see the maximum. So here's the thing. You bought the seats on the plane for 7 years. You bought the room in the policy for 7 years. So guess what that means you can do? We can fill those seats up. So let's say that this business owner continues to have rock star performance over and over again. Now, I want everybody to hear this because it's really, really, really important. I don't want anyone coming back and saying, well, Craig said, because I bought term, I can put in the full amount for the next 7 years. I don't know if you can. It's based on the MEC level, which changes every year. So based on what we know right now with how things are projected based on the dividends, this is what you could do. What if dividends go up? What if the MEC level changes and I can't put this amount in? Maybe I can put in 75,000. The point is we need to check that every year. We need to call policy services, or your implementation specialist can help you with that. But I'm just showing you as an example, this is what is maximum possibility. You may not be able to put that full in based on the MEC, but I just want to make sure everyone understood that piece. That is the maximum that we can put in. And then guess what's happening after year 7? We're not paying for the extra seats on the plane. So now we're just dropping down to the base. So at year 9 and on, $5,750. If we go back to thinking about the year by year projections, I want to show you something that just blows me away. So I've got a policy, my oldest policy, its birthday is actually this month. It's on Friday, the 20th of October. I just paid my premiums. It was so fun. The cash on cash that I'm getting is somewhere around every dollar I put in, I get about $6 back. And a lot of people say, well, I'm not seeing that type of cash on cash number. Well, what does cash on cash mean? What we're doing is we're measuring every year when I put $1 into the policy, how much growth did I have? So look at this. When he's doing max funding, when he puts $1 in, even in year 1, he's got 93 cents. Year 2, 99. So by year 3, when they put in $1, they're getting $1.04 back. Now let's go down to year 10. Look at the cash on cash. How many policies have you seen where you can put $1 in and get $8.78 back? He's putting in $5,750 and it grew 50,000.
Craig, you might have to repeat that like 3 times because people heard what you said, but they're not picking up what you put down because it just doesn't sound possible.
Right. So Chris, if I showed up at your house and you gave me $1 and I gave you $8.78 back, would you want to do that again next year? Would you call me back?
I'm actually not leaving. So I'm just staying for dinner, make a bed for me. Every day, I'm just going to kind of give you another $1 and then see what happens.
Yep. So what we're talking about, I'll just repeat it, is we're doing a cash on cash measurement, which is giving us a gauge of how much, what's the ratio of what we're putting into getting out. So in this case, we're putting in $5,750. The policy grew 50,000. That means for every $1 we put into this policy, we're getting $8.78 back. This is just the place where we're storing our money before we go do something else with it. But these numbers are pretty wild. I mean, we're typically seeing $1 for $3 or $1 for $4 at this age of the policy. But this guy, if he funds the policy this way and the MEC level allows him to fund the policy this way, holy smokes, 878% cash on cash. This is pretty cool. I got pretty excited about that. The other thing to look at, what if this business owner decides, you know what, I don't want to do this anymore. I don't want to do this business anymore. Year 10, well, guess what? The dividend alone is $29,923 right here. The cost of the policy at the base is $5,750. So could this policy be put on autopilot? Could this policy pay for itself? If every year it's growing 29, 30, 32, 33, 35, this policy could absolutely pay for itself going forward. So it's another option for this business owner. Shut the doors, sell the business, and then just put the policy on autopilot. So what questions do we have from the audience? Using these numbers, is the life insurance have to get documentation income? So Kel, there are times when we do bigger policies, especially if we're doing business owned policies, they'll want to look at business documentation, cash flow, P&L. So in this case, I don't suspect we'll have to do a lot of that, but if we start getting into some of the really, 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 really big numbers, that is a possibility that want to look at some of the business income for qualifications. And some of that's going to depend on too, if you want to have the business own the policy or if you're going to own it on a personal level. Let me know, Kel, if that answers your question. And then Deborah's got a question about autopilot. Is that self-funding? So when I talk about autopilot, each insurance company calls these things different things, reduced, paid up. But essentially, yes, it's on autopilot. You're no longer paying that $5,750 of base. The policy is paying for that out of the growth of the policy. So what we're talking about is if you don't want to fund this annual premium out of income, like Chris was talking about earlier, we always want this coming out of our income or growth. You certainly could put this policy into that mode where it pays for itself going forward because there's plenty of cash value growth to cover it.
Yep, absolutely.
And then Deborah's got another question about cash surrender on a policy. So the cash surrender on a policy, really that would be our last option. We have a lot of other things we can do if you ever want to surrender a policy. But the cash surrender on a policy is if you want to just take your money, close down the policy and walk away. That's essentially what the cash surrender value is on your policy. There could be tax implications with the cash value surrender. And the way that works is whenever you cancel the policy and walk away with it, they're always looking at the cost basis. So how much have you put into the policy versus how much has it grown? And so if you're in the early years, and actually here's the measurement, see this projected premium to cash. Initially it's down $8,000 and then it's, goes positive at year 4. This is actually showing you the difference between how much you've put into the policy versus the cash value that has grown. So guess what? In the early years, because we've got this $2 million of death benefit, there's a cost to that. The insurance company is not a charity, so we do have some costs built in there. But it takes a few years to get efficient to where you actually are making more than you're putting in. So if you surrendered the policy at, say, year 4, you've actually got a gain there. When you have a gain, guess who wants to share in that? Your good friends at the IRS want to share in your success, so they want a piece of that. So when you do a cash surrender, just know that if you were to do a surrender on your policy and you have a gain, some of that's going to go to the IRS. Chris, anything you want to add on that?
No, I think that's a good explanation of it. I mean, I don't know what else I could add to it. I mean, the only other thing I would add to that is when people talk about cash surrender, a lot of times that word cash surrender doesn't come from whole lives because on your illustration, it's not going to say cash surrender in most cases, but that's usually common in IULs or universal life policies because there's accumulated cash value and then there's the cash surrender value. So in an IUL, there's a thing called the surrender charge, which basically is a charge the insurance company puts on your policy year over year. And it's usually diminishing percentage, but means that if you have, I don't know, in this case, let's just say $100,000 in a policy, you're not going to be able to take $100,000 out because there's a cash surrender value, which in an IUL would be significantly less. I've got an awesome training I'm going to do on IULs and show some IUL designs I had done on myself. And these came from an IUL agent that said, these are the best things for infinite banking. These beat whole life. Okay, great. Prove it, show it. He gave them to me and I have them all sitting literally right here. We just haven't done a training, but I just want to kind of explain that. So on this, so I'll just give you this is an IUL and I just want to explain this IUL was done by an agent that absolutely understands infinite banking, claims he sells whole life insurance and said that this policy is designed at the highest early cash value you could ever design in an IUL. I'm like, cool. I've heard that there's ways to build these IULs with the highest cash value where the agent reduces his commission. So can I just give you guys the numbers? I put $12,000 into the policy. I have an accumulation value of $9,959. Not bad. I put in 12, I got 9,959. My cash surrender value is 8107. So I have 9,959, which is about what a whole life would give you, actually probably a little bit more than that, but I only have a cash surrender value of 8107. This is the best policy they could do for an IUL, which I agree is far better than most of the ones we see, or far better than some of the other ones I have. But I just want to explain, like, this is why IULs don't work. One of the reasons, there's many, but if I got 99.59, why can't I use 99.59? Here, you can use every bit of that cash value, okay? But here, I can't. I can only use 8107. So that's also another way to spin the cash surrender value, which is typically a very common term in IULs, not whole life. I'm looking to do this on a personal level, replace my mortgage with a policy loan. So I'm considering a dump in like this with 12,000 premium, but not sure if my income will support this since it's not consistent income, but comes in waves and lumps. Oh, that's a great. So Kel's question, Craig, is a lot like this client that we did this example for. This client's a business owner, wants to do a policy, but has inconsistent income in his business because, hey, businesses have ebbs and flows. Kind of like Kelly, in your personal world, you have ebbs and flows. We all do. So it's really the same. Craig, how would you answer that? Because it's really everything we just showed, but he's talking about it on a personal level, but personal or business is really one and the same.
So I think with Kel, one of the questions would be if he's trying to make sure he qualifies for 12,000. So typically what happens on the premium qualifications is that you need to have about 20 to 25% of your gross. That's the maximum premium deposits you can do. So if you wanted to put in 12,000 on an annual basis, you would need to be able to qualify and have an income of, what is it, 48,000 or so, 48 to 50,000. So what we'd want to make sure is that your gross income is at least 48 to 50,000. Then you could qualify for that 12,000. Now the dump in, if you wanted to do a large dump in, we just need to make sure it's going to work with that premium. So if you did a $12,000 premium, it would be really hard to get 100,000 in there. Matter of fact, we probably couldn't do it. But that's going to come down to some policy design. And that income would be your personal income. So they're typically looking at, if you have a spouse that's working, they don't want to look at the combined, they want to look at your gross income. But what we could do is look at what's that maximum that you could put in, and then we can figure out what the dump in is from there. And some of the dials that we can turn on the policies would be, so we have this 75-25. If I wanted to get more of a split, I could turn that into a 60-40, which means I can, then have a little bit less on the 23. I could drop that down. But anyway, those are a bunch of design considerations. Those are the ingredients that we put in the bowls. We mix them up and we'll figure out, we'll do the best job for you in designing that policy. But typically we just want to know what the numbers are that you're working with, and then we can get that for you. And then Peter's got a question here about the return of premium, total cash values over $1 million. Chris, I don't know if you have a way you want to answer this. What I'm kind of thinking about is on Peter's question, the cash on cash, we're measuring on a year-by-year basis. And then there's ways to look at this from a cumulative perspective of what you've put in versus what you've grown. But the cash on cash is really just a year-by-year measurement. I put $1 in that year. What do I get back that year?
I was just going to say, Peter's been doing IBC for a long time, but I mean, what he's saying is absolutely correct. So he's essentially saying, aren't you getting the 878? Can you just highlight that line item down there? Because the 878 one, which was year 14, just so everybody's eyes are focused on this one that we're talking about. So Peter's basically saying you made 878.92% cash on cash. In other words, you put 5750 in, you get to take 50,000 out. So how we would figure that out is if this is the amount you grew that year, we would take the 538, subtract the 5750 from it, because that's your new deposit. And then whatever's left, we would basically divide that in and divide that into the premium. Because if you put 5750 into an investment in the first year, can that 5750 earn you 50,538? So do any of you know anywhere where you can invest $5,750 and make $50,538? Because that's essentially what we're showing. I mean, the net would be the 50 minus the 5,700. But the reason Peter's then going on saying, isn't that because you have $1 million, $1,087,577 earning interest and dividends uninterrupted? Absolutely. Remember in the very beginning when I talked about change one thing and that's where your money goes first. Why? Because the insurance company will pay you interest and dividends on all the money, because when you take, because it wouldn't matter if you took all $1,087,577 out of the account. Let's say all that money was out working for you somewhere else. How much would you still make when you put 5,750 in? You'd make 50,000. It wouldn't change because you still have $1,087,000 in the account, because this $1,087,000 is in the account. Although it's collateralizing the loans the insurance company gave you, it's still earning. So there's no bank on earth that can do that. None, not a one. There's really no other vehicles on earth that can do that except for the specially designed whole life like you're looking at. So that's all Peter's doing, is he's just basically saying it's the compounding on all the money is the reason you have an 878% cash on cash return. Exactly that. He's sort of just agreeing with you, Craig, is how I would look at it, and just saying, duh, folks, it's because you got $1 million earning interest and dividends. No wonder you made 50,000 on 5,700.
Yeah, absolutely. Yeah, Peter's got it spot on. So and this is the thing that people need to look at, is time's going to pass regardless. So that 10 years is going to pass before you blink your eye. And everyone gets so focused on these first few years when it's negative. But guess what? This is very powerful down here. Let's continue on. So Catherine, hey, Catherine, good to see you out there. You've got a question about how often is the MEC available to be seen and planned for? So some of that's going to depend on if you're doing monthly. If you are actually doing monthly premium deposits, that MEC will change every month. So if you're trying to figure out how much you can put in extra above and beyond, it's just really a call to policy services and we can find out. Now, if you're doing annual payments, that will be done annually. So typically at your policy anniversary, you'll get your new MEC line. So it really, that MEC line is going to be changing based on how you are putting those premium deposits in. If you're doing a monthly, MEC line changes monthly. If you put it in annually, it changes annually. And Emily is asking about the 25% split.
Well, where she's getting caught up is a lot of times when you give people all this information, Craig, they get hung up on numbers. So she's hung up on the 75-25. She's like, oh my God, if 25% has to go to the base, 25 of that amount is not 7,500 or not 5,700. So she's confused because she's trying to do the math in her head just on the 75-25, but it's way more complex than that. I wish it was that simple.
So where the minimum comes from on that one, Emily, is the 5,750 is that 25% of the 23,000. That's the base. But because we bought extra seats on the airplane, or we bought extra room to put money into the policy, it comes with a cost of $1,344 a year. And then we also want to make sure we cover that PUA rider fee. This $120 keeps the door open for us to be able to put more money in every year. If we don't pay that, the insurance company will shut that option off, and we're just down to this $5,750 plus the base. But that's where that number is coming from. It's the base plus the term plus that PUA rider.
Yeah, and I just want to add one thing. It's kind of just a thing, because now you're all looking at one of the examples that we did, and we talked through this, where this client put 123 in the first year, but then is minimum funding it years 2 on. So, when you do that, you can see the impact of how that hurts you. If you look at the projected cash on cash return, remember the old one in year 14 was 800 and change. Now you're at 241. And that's that whole efficiency thing. If you design a policy to hold a certain dollar amount, if you don't put that in and you miss your mark or you underfund the policy, like, you lose efficiency. And that's the impact there. You go from 800 to 241. Now, listen, I would always tell people there's nobody that's ever going to complain about a 241% cash on cash return. I mean, you give Craig $5,871, he hands you back $14,151. You're not upset, which is great, because that's why Brent and all of us always say, like, we have no clients that are upset with us, because even when things go bad and you don't do what we designed the policy to do, it still works. But you can see here the differential where you really want to strive to try to get the maximum amount in for the policy design you set up. And I love that Kel was commenting in the chat. He was asking, in a private message, well, why wouldn't somebody just put 100% of their income through this? I mean, come on, like, why not? That's stupid. I want to put 100% of my income. I mean, now that all of you are looking at these numbers, how many of you want to just run 100% of your income in, right? That would make sense, wouldn't it? But then he said, and then I told him, I broke the bad news. I said, you can't. The insurance companies won't allow it. Now, it is possible, but it's very complicated. It's done with layering, structuring, and is done over many, many years. You could get 100% of your income in, but we don't teach that just because from the surface, it's basically impossible. The insurance company will not allow it. And then he said, oh, I finally see something that's too good to be true. And right, putting 100% of your income in would be great, but you can't. So that is too good to be true.
All right. So let's see. Lynette's got a question here as well. Said, so you're cashed out an old life insurance policy, which was 22,000. We had borrowed against it for about 13 and our cash out was 66. I was confused at that. It's a good point. So when you borrow cash value, let's just say that we're up here at end of year one, you see there's $114,000 of cash value. If you borrowed $100,000, your available cash value will go down to $14,827. That doesn't mean you're not compounding on the full amount. This is like a gas gauge. Just think of it as you drive your car, your gas goes down. You took a loan, your available cash value is going to go down. As you repay your loans, that's going to go back up. So I think, Lynette, in your case, when you had an outstanding loan and you cashed in or surrendered the policy, they're just going to give you the difference of what that cash value was minus the loan, and then you walk away with that. So that's how that piece works. Michael's got a question about what is the effect on a policy if you take a loan and don't pay it back right away? The fact of the matter is, let's just take this as I've got a loan calculator here. Let's just say you take out a $10,000 loan and we're not going to pay anything back on it. So if I take out a $10,000 loan and I'm paying 5% loan interest, guess what? At the end of the year, I've got a $500 interest charge. So Michael, to answer your question, if you don't pay this loan back, guess what happens? $10,500 is now your new principal going into year two. The insurance company doesn't care if you pay this. They're not even going to, chase you down. There's no structure to this. It's just going to be added to the principal going into next year. So as a result, now instead of 500 loan interest next year, it's going to be 525 because you're paying interest on a higher amount. So let me know if that answers your question.
Craig, you're just flexing, man. You're showing all these spreadsheets you've created. Everybody's like, man, I want to create something like that does that. Yeah, well.
Well, this is actually what I use to manage my own policy loans. So I put it in and play around with it. But that's how the policy loans will work. Now what's cool, and Chris, we've done some teachings on this. For example, let's say I put in $500 a month back into my loan. Do I still pay 5%? Who thinks that I still pay 5% if I pay my loan back throughout the year? Anybody have? Yes. So Joe says yes.
Yeah, right. It's not 5%.
3%. So here's the beautiful thing about it. This is a simple interest loan. What's happening is every time you put $500 back into the loan, 100% of it goes to pay down the principal. They then calculate the remaining interest off of that principal number. So look at that. At the end of the year, my interest charge is $338. So on a $10,000 loan, that's 3.38%. So by being an honest banker, I actually bought my loan interest down from $500 to $338. That's pretty cool.
Yeah. How many of you want to buy all your loan interest down the way he just showed? Like on your car loans, your credit cards and everything? You can't. Doesn't work like this. Credit cards might, but that's, I think, a real, Craig, I've never seen you show that. And that's definitely flexing your new skills with the awesome spreadsheets, because a lot of people, when we say 5% interest on the loan balance, people are just like, oh, it's 5%. But you just proved it. It's not 5%. And this calculator can kind of, based on any repayment, because when you're your own bank, folks, you set the rules. So whatever amount, if you took a $10,000 loan, you can set your repayment, your recycle, recapture to be any amount you want. You know, we teach it a lot of different ways, but I mean, you could put 100% of the interest made back in. You could put half of it back in. You're the boss because you own the bank. So you just basically do it. And this spreadsheet allows you to literally dial it in to be whatever you want. And then you can see the net impact of being an honest banker, which 100% of the time will always reward you massively. But yet people don't want to be an honest banker, which is the biggest struggle we have with the money multiplier and being your own bank, is people just fail to be an honest banker. They steal from their bank.
Yep. Don't steal the peas. Let's see here. So Lynn has got some updates. So her policy was bought in 81. Man, I bet you that's got an awesome cash value growth of the base. So Lynn, I don't know if it's something we could look at. I mean, is it paying for itself? Is the policy growing to the point where it can pay for itself?
Craig, it's super easy. Here, I can sum this one up. Don't ever, ever, ever allow your dividends to pay your premiums, unless that's your only option. Unless you're like, okay, well, either I got to find a way to have dividends pay premiums or have it pay for itself, or I got to cancel it. But Lynn, we know you. That policy starting in 1981, if you got excited about an 800% cash on cash, I'll bet you that one's probably more than that. I seriously, I know it's just a regular little old whole life, but please do not let it pay for itself. Whatever the premium is that you put into that policy, keep putting that premium in and just run the math, or send it over to me, Craig, or Steven, and we'll run the math. And once we show you the number back, there's no way you'll ever ask when that policy can pay for itself, because you'll just keep putting money in your bank until the day you can't.
Yeah, and kind of the way I look at that is, let's say that you needed to put in $3,000 a year into that policy. My question is, do you have something in your life that would cost at least $3,000 a month? Because you can put that into the policy and then pull it out and you still make money. So I mean, that's why I was telling someone the other day, because I'm excited about paying my premiums for my policy that's due this month, or on Friday. I said, they're going to be rolling me down in the hospital on the gurney, and I'm going to be yelling at the last minute, make sure you pay my premiums, because it's so efficient now. It's just a beautiful machine. But anybody that has old policies, absolutely keep paying those, because the money you put in, you're going to be able to get a lot more out.
I mean, shoot, Lynn, like, it would be hard to find somebody that like literally would give you 100% of the premium and then come up with an agreement where they just split that year's growth of the policy. That'd be the greatest investment that person ever made. They just pay your premium, like loan you the money for your premium, and you give them half of that year's growth. Every year they'd get a raise, and you'd screw yourself, but that person that lent that premium would be a really happy person. So when you mention it's kind of like nails on a chalkboard, we get this a lot when people say, is it better to cash it out because it's old and it's not designed right? And, then should I just take that money and put it into a new policy? Absolutely not. As long as it's a whole life, anything that's old is like fine wine that you've seen in one of those wine cellars with the cobwebs. The older it is, the more expensive it is, the better it normally, well, that's to be discussed, but typically the better it is.
All right. Well, I know we're getting close. We have a few more questions. Maybe we can just hit them real quick. So Emily's asking about the dump in. Is the extra 100K dump, but the annual premium of 25 includes the 70 minimums and more PUA? So in this policy design, 100,000 is the dump in. The 23,000 would be considered more of your premium deposits. Those would be the things you're doing annually. And that is broken into that 75-25 split, which includes your base, your term cost, your PUA rider fees. So if that's not clear, let me know. But the 100K is kind of that above and beyond piece that we can continue to do, because we we purchased some room in that term. And then last, is it wise to convert an older IUL into a whole life?
Oh boy. We'd have to
I
review
think
it.
that'd be a good,
Yeah, that'd definitely be one that we'd have to review. I had an old VUL, very similar to an IUL, and I had an old UL. And I think 2 years ago, I did a 1035 exchange into a properly designed whole life, but I waited a long time to do that because I wanted to wait till it was out of the surrender period, and then I did it. So there's a kind of an efficiency point when that answer should be yes. So we'd have to just review the in-force illustration to make sure it makes sense. You don't want to do that. You don't want to convert it if you're going to lose too much in surrender fees on the IUL. What else we got there, Craig?
looks like we have another one from Kel. On the loan policy, isn't the interest charge simple interest on the amount of the loan borrowed, or is it simple interest on the balance of the loan at the end of the year? So the way I'm calculating it and the way it works most times is what'll happen when you take that $10,000 out, they're going to basically take that 5%, split up on the interest charge per month. They're calculating what is your interest charge per month, but it doesn't get added to the balance, right? So that gets kind of set to the side. And at the end of the year, that's when they'll say, this is the amount of interest that you've accumulated. Do you want to pay it or not? So the loan interest is kind of held separately than the actual principal amount. So Lucas asking if there's a way to get a spreadsheet like that one paying off the loan. Are you talking about this one? I could share that one. Yeah, I mean this is not rocket science, but yeah, I'd be happy to share it if you want to reach out.
Well, Craig, what's coming soon?
So what we've been working on is we're working on that done for you program. We're working on some ways to do in-depth analysis. So we've done people will come to us with some complex problems, and Chris, we've had a few lately where we spend a lot of time crunching numbers, just figuring out what's the best way to move money around and structure it. So that's what part of done for you is. We've got a bunch of different tools, and we're just really trying to solve problems. So if it comes down to it, and this is a pretty simple one, just kind of putting loans in, but if somebody's got some complex problems, between Steven, Chris, and I mean, we can get together and we can figure these things out. We've got a lot of tools built that can solve problems.
And the other thing we're going to do eventually, I can't tell you when this will be, but we're going to basically create bundles of these spreadsheets. So there's a lot of people that just want to kind of tinker around. They want to play around. They want to have these, that they can use. So we're going to literally create bundles of spreadsheets to do different things that you all can just buy. I mean, they'll be very inexpensive, but for all of Craig's time, I mean, we're just trying to make it make sense. And you'll be able to buy a bundle, maybe like it's a debt pay down bundle or, an investment bundle. So we're working on creating all that stuff. So it'll be available very soon.
So with that, I know we're at time, so I don't know if you want to do some wrap ups, but
Steven, what do we got going on? You wanna wrap us up today and talk a little bit about some of the cool things that we've got coming?
Yeah, it's the least I've ever talked on one of these.
It is like you've been quiet.
That was awesome, Craig. Nice work. I got to get some emails done, so that was nice. Yeah, I mean, we always have a lot going on. I mean, the mastermind experience in Vegas is next weekend already. It's sold out, but looking forward to seeing a lot of you on here right now out in Vegas next Friday, Saturday, Sunday, Monday. And being in Vegas the weekend before Halloween should add a little extra excitement to the experience. So we'll see how that goes. We do have, let's see, the following weekend, I think it is. Yeah, the following weekend is our Money School Essentials 3-day foundational virtual training class. So that's the 3-day training we've been doing now for 3 or 4 years. And it's basically the foundation of everything that we do. So Chris and I spend 10 a.m. to 4 or 5 p.m. with you all day Friday, Saturday, and Sunday. There's no breaks. We just go wide open for 3 straight days. We bring in some experts. We bring in a bunch of opportunities. and we show you how to really bring all of this stuff together that we're constantly talking about and how it all works together. We go in deep on different subjects and topics. So if you like these wealth webinars, you like the YouTube content, you have never seen nothing until you get to one of our 3 days. So make sure you join us for that. I could probably post a link. We do have a discount. We still have an early bird discount going. Let me just pull up. Let me just post that in the chat box right now. And then what else we got going on?
Oh, 3 day, and I think that's probably the biggest news.
That's about it for the end of the year. We're trying to keep December kind of clean just with the holidays and family stuff and things like that. I know, Chris, you'll be in Dallas, I believe, mid-November.
Yeah, so if any of you are in the Dallas, Fort Worth area, we're going to be doing a pop-up event, just kind of real low-key, just show up, hang out, chat. It's not going to be anything formal, not like come, sit down, listen to presentations. It's just going to be kind of meet and greet, hang out, talk. So if you're in the Dallas, Fort Worth area, stay tuned. We're going to be talking about that about 2 weeks out from the event, and that'll be a lot of fun. And they got the 3 day coming up. We got the experience. This Thursday, tomorrow evening from 6 to 8, we've got our Private Money Club 2-hour group coaching for all Private Money Club members. So if you're in Private Money Club, you should probably show up tomorrow, between 6 to 8. You would have been emailed or text a link so that you'll know exactly how to go there if you qualify to be on that.
Yeah, that's currently for Premier members. So if you're not a Premier member yet, make sure you get signed up. Tomorrow should be pretty good. So get on that. And then one other thing, Chris, real fast, I did add a schedule link in the chat box just now. If anybody wants to get a hold of Craig, if you need to get a banking policy started or you're thinking about starting another one, just put Craig's calendar in there so he can help you guys get those set up as well.
And other than that, if you want more info, stay tuned to our YouTube channel, our Facebook groups, and also just stay tuned to your phone, because if we're going live, usually you're getting a text.
Guess what's happening today at 4:30 Eastern?
Oh my goodness, we forgot about Ask Me Anything happy hour. Craig, tell them what they're going to be getting at this awesome Ask Me Anything Brady Bunch style.
Hey, you get the Brady Bunch. You get our whole team. Come with your questions. Ask great questions. We're always kind of joking around a little bit, but our whole team's there to kind of help serve you and just provide perspectives on, different questions that you bring to us. So it's a good time. Show up if you haven't been there. Ask
Craig. Yeah, I think today's is probably going to be Ask Craig Anything, and we might change the name tonight because it's going to be you.
Well, and you can ask us anything. We just may not answer.
Yes. And with that, I'm going to call that the end of this wealth webinar, folks. Thank you all for giving us your time, the most valuable resource you have. And remember what I said in the beginning. This is the best opportunity in anyone's life right now to get ahead and to become wealthy. And all you got to do is a little extra, do what everybody else is unwilling to do. So go out there, kick some ass, take some names, and we will see you this afternoon at 4:30 for the Ask Me Anything. Thanks, everybody. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.